As you would imagine, one of the most common questions that I get all the time is, Dre, what is the number one risk to my retirement savings? And normally, what we're expecting is me to say something like, well, it's the stock market, or it's inflation, or maybe it's even taxes. But the truth is, it's none of those things. The reality is, the most dangerous aspect of retirement planning when it comes to the risk of you losing your retirement savings is you just outliving your money. And the reason is because there is dangers in everything. In a lot of ways, you can control and predict the stock market. I know you may not feel that way, especially in the current year and environment, but there are a lot of things that we know and have seen, and there's a lot of data that supports it. There is ideas and data and ways that we can adjust from a tax perspective. And then when you're talking about inflation again, there's a lot of control that we have. But the thing that makes us outliving our money so dangerous is we don't know pretty much any of that. We don't know how long we're going to be here. We have no earthly idea. We don't really know what's going to happen from a straight line perspective or a consistently perspective of the cost of our health care in retirement. We don't necessarily know all the things that we're going to do in retirement and how much those things are going to cost. There is a lot of unknown when it comes to time. Health always is the one thing that can work for us or work against us. And yet is the one thing that's so difficult for us to be able to really wrap our mind around. Like, how long should something take? How much preparation do we need? And how long are we going to be retired? And because time is such an uncontrollable variable, that once we start taking the money out, all of a sudden our money is no longer compounding in our favor. Now we're starting to work against time. And time is a really tough thing. And I look at it in sports all the time. They always say Father Time is undefeated, right? The idea that no matter how long Tom Brady wanted to play, and no matter how long LeBron James wants to play, no matter how long these athletes want to play, eventually time is going to win. And because time is undefeated, as we often say, that means that we are going to be fighting against a foe that has never lost. And the best that we can do is enjoy the time that we have, optimizing the time that we have, adding more wisdom and less worry. But once we start taking the money out, it's like the clock starts working against us because it is what it is at some point. I mean, things like sequence of returns. It's a very fancy way of saying that the loss at the beginning of retirement is more damaging than that exact same loss at the end of our retirement. Because if things are compounding for us, we're growing, growing, growing. If things are compounding against us, it's shrinking, shrinking, shrinking. And the idea is if I lost 10% my first year and I had $1 million, I went down to 900,000. If I get 10% the next year, am I back at a million? Well, no, you're 10% of 900,000. I lost $100,000 worth of my compounding power. And so as long as we recognize that, that means that I then need more like a 15% return to offset and make up that difference. Well, what if you lost 10% 2 years in a row? And now you're at 800,000. But the good news is we can manage the other aspect of this risk so that it minimizes the risk of us running out of money. So first and foremost, you want to look at your income and your expenses. And your income is going to be, where's my income coming in? Is it a Social Security? Is it a pension? Is it in a Roth? Is it in my business? Is it real estate? Where are my income streams coming from? You need to list all of your income streams. And then we can see how much money we expect to have in retirement. And then our expenses is our lifestyle. And our lifestyle, depending on what we want to do, we normally need to look at our goals. What does a dream day look like for me? And what does that cost? Do you want to golf all day? Well, wonderful. How much is the golf membership annually? Do you want to travel everywhere? Well, fine. How much does that cost annually? We need to know what we want to do with our time. Whether we want to sit on the back porch with a book, well, then we just need to make sure that our back porch is looking good. And so maybe we just need to have a new paint job, or need to have some wood pillars replaced, however that looks like. We just need to make some updates to our back porch. But if we want to be going out and about, what does that look like when you're planning and preparing for retirement? And then, of course, we need the normal expenses like keeping my lights on, food on the table, and gas in my car tank, and then our health care expenses when we're visiting the doctor, and some of those small, normal, everyday things. We need to capture all of that. And we need to see how much our expenses are in retirement. Am I going to carry debt into retirement, or am I focused on getting debt free leading into retirement? These are all things that we would consider. And then from there, we have the idea, well, this is how much money I'm generating. This is how much my expenses are. Do they match? Do I have any sort of a buffer? Or do I actually have a gap and need more money? Depending on the answer to that, that is where we make the adjustments from our lifestyle or investment perspective. We either need to have more money, and there's normally three levers that we always talk about. You either work a little bit longer, you either spend a little bit less, or you make a little bit more. And those are normally going to be the three levers that you have. And for everybody, we're different. So you choose the one that makes the most sense for you. But we want to get a match as best as we can. This thing that we'll normally do is we'll create a buffer. A margin of safety is a common term that you'll hear in the investment world. And all we're really saying is there is a little bit of risk of the unknown. And because I don't know everything, I need to give myself a little bit of a buffer to assume that I'm wrong. Right? That's all we're basically doing. We're quantifying the probability and likelihood of me being wrong. And so when we're investing, we're looking at these companies and we're like, man, this is a great company. This looks like a wonderful investment. But what is the chance of me being wrong? Well, worst case scenario, we would be somewhere around half of it. Okay, well, then I need to have a margin of safety of 50%. And so if I believe the stock is worth $100, I'm still not buying it unless it's around $50 because my margin of safety is 50%. Obviously, that's a very large margin of safety, but you get the idea. I'm not buying the stock when it's $100 because I believe it's worth $100. I'm buying the stock when it's at $50 because I believe it's $100. And that is my margin of safety. When you're talking about your healthcare, well, we know healthcare on average is about $6,000 to $8,000. Well, what is my margin of safety that I am in that group that my healthcare expenses are a little bit higher? I believe my taxes are going to be around 22%. That's kind of what they've been. And I was looking at my income and things like that. Well, what would be the margin of safety if we said, well, maybe they raise taxes, or maybe they add a new bracket, or maybe they adjust it in some way? I just win the lottery. Like, I don't really know what's going to happen. But what is my margin of safety? I cannot just make a plan assuming that my taxes are 22% and I expect them to be 22%. And that's the only thing that I plan for. That is not a margin of safety. A margin of safety assumes, well, what is the chance that I'm wrong? Well, the highest tax bracket is 37%, Dre, and I'm probably not going to be there. But let's go ahead and plan as if I would be taxed at 32%. How would that impact my plan? What adjustments would I need to make, right? That would be the buffer. So we're saying I'm believing my taxes will be around 20%, but I'm going to plan as if they'll be 32%. I believe I'm going to spend $8,000 on my healthcare, but I'm going to plan as if it's going to be $15,000. And then we make these adjustments. And then we would do the same thing with our investments. We would do the same thing with inflation. I believe inflation is going to be 3%, but how do I know that there won't be that 1 year in there, like the one that we had not too long ago, where we're at 40-year highs on inflation? What am I going to do if that happens? Right? These are the type of things that we're planning for, the things that I can't control, but will maybe happen over the life of my retirement, right? If I play my cards right, I'm going to retire for 30, 40 years. What's the chance that inflation is going to be kind of crazy? Well, there's probably a likelihood it's going to be at least 1 year in there. What's the chance that my expenses or my tax rates might change? Well, there's probably a likelihood that that could happen. We're recognizing that retirement isn't a straight line where this is the amount I need, this is the amount I'll always need, this is the amount I spend, this is the amount I always spend. There's a little bit of flexibility needed in there. And so normally that's the second thing that we end up doing. First, we got to figure out how much we're going to make with how much we need. Then we give ourselves a margin of safety, give ourselves a little buffer in case things are happening in the world that are just a little bit too crazy. And then normally when you're talking about how we put all of that together, your income plan, that's really going to be your withdrawal strategy. That how we take the money out of my different investments to fund my lifestyle will be one of the main factors when determining how well we are protecting ourselves against these events that happen. Your withdrawal strategy is not just about whether or not the market is doing good, which is a very important part of your withdrawal strategy, but it's also about how do I feel about inflation? It's also about how am I choosing some of these companies? It's also about how I feel about taxes. All of that has a role in your withdrawal strategy because we can determine whether or not we're going to take the money out of our pre-tax accounts first, which are normally going to be taxed as ordinary income, like your 401k, 403b, things like that. And they also have the required minimum distributions, which is a tax component, or whether we're going to take the money out of a taxable account. So I've already paid taxes on it once. And as a result, as long as it's been invested for a year and a day, it should be taxed, generally speaking, at a capital gains rate, which is much more favorable than your normal tax rate. But then you also have the third option of whether we just want to have the money in a tax-free account. And so you have like Roths and municipal bonds or health savings accounts. And if you have the money in there, well, then I can take the money out tax-free, which gives a variety of benefits. Naturally, one of them is it's tax-free. That's very nice. But another one is I have to take out less money. That if I wanted to spend $100,000 a year, but I was being taxed at 20%, well, that means I have to take out the $100,000 plus the 20% that's going to be paid in taxes, which is then decreasing how much money that I'm actually having in my investment account, which also has the possibility of increasing my tax rate because I have to take more money out to fund my lifestyle. And so there is this whole withdrawal strategy that a lot of us underestimate. So when you're really thinking about your withdrawal strategy, you can see how it plays a role from a tax perspective. But then from our investment perspective, you guys know I'm a big fan of the three bucket strategy. And that has to do with us handling the risk of the stock market and overcoming inflation. That I need to have a certain amount of my money allocated in assets that at least keep up with inflation, that I can have a certain amount of money allocated in liquidity, which just means it's basically cash, and I can then live off of that. And if we have a certain amount in liquidity to live off of, then that means I don't have to use the other two buckets as readily. And so if the market is not doing well, I've given myself the opportunity to wait for the market to recover. Because we do know that the market, generally speaking, from a historical perspective, has always recovered. That after 9/11, the market did really bad, but it recovered. After the Great Recession, the market did really bad, but then it recovered. After COVID, the market did really bad, but then it recovered. I just have to have my money somewhere that allows me to wait for my investments to recover. So that way I'm not taking money out in those losing years. I'm giving myself the time to not only recover that loss, but hopefully to even grow from that loss, where I've surpassed where I used to be at. And so you can see why the withdrawal strategy ends up being a very important role in how you decide you allocate your money. Now, everybody's a little bit different on whether you will actually need the third bucket. All of us are going to have at least the first two buckets. You're going to have the liquid money that you're spending, and at a minimum, you're going to have the middle bucket, which is your income producing bucket, which is normally going to be things that keep up with inflation. So your bonds would be there. You probably could have your annuities there. I've seen people have preferred dividend paying stocks there because those are generally a little bit less risky. But we're really saying that I probably have to have something that's at least keeping up with inflation, that 2 to 4% return. And then I probably have something like my CDs and my money market accounts in that bucket number one. But for some of you, it'll make sense to also have bucket number three, which is your growth bucket. And if you have the growth bucket, that is where we're replenishing our asset because we're outpacing inflation. And then most of the times, you're going to be outpacing how much you're actually taking out. And so we'll have a portion in that growth bucket, and that could be your business and your real estate. That could be your investments in the stock market and ETFs and individual stocks. For some, that's going to be commodities like gold and precious metals, and that could also be crypto and Bitcoin, just depending on who you are. But that's our aggressive bucket. We know that there's risk in that bucket. And by risk, we simply mean that it has the chance of going to zero. It may not be very likely that it'll go to zero, but we don't want to fool ourselves into not recognizing that that is an aggressive risk bucket. But if we're not touching that bucket for at least 5 years, it should recover from whatever those market downturns are. And that's generally how it's happened over time. Isn't always that way. Of course, it's hard to say always. And as a fiduciary, I can't say always, but I can say historically, that's how it's performed. And so if you're someone that has those three buckets, now you're able to protect yourself from the perspective of inflation and market volatility, which gives us the best chance to make sure that we're not living longer than our money is living. Now, if you haven't noticed, there's a lot of moving pieces when it comes to retirement planning and making sure that you're not at risk of running out of money. And that the reality is a lot of us, we don't test our plan. We go to a retirement calculator, we get the number, we tell it how much we have. It tells us how much we should be able to take out every single year, but it doesn't take the variables into consideration. And that's why we stress test our plans. Now, I want to give you the ability to do that yourself. And in just 15 minutes, you'll get a quick gut check on whether your current plan can support your retirement lifestyle or if there's a risk that you'll outlive your money. We walk through your income and expenses, how long your money is likely to last, and how taxes, healthcare, and inflation could impact your retirement future. It's not a full plan, but it will help you spot warning signs before it's too late. Click the link below, and in less time than it takes you to have your coffee, you'll know whether you're on track or whether you need to make some small adjustments.